Morning everybody. Thanks for attending this morning's session on how to use listed products in your portfolios. Look, Zenith are researchers predominantly, but we do construct portfolios as well. So surprisingly enough, what I'm not here to do is actually tell you how to construct a portfolio brick by brick. Because ultimately we think that all of you in here, whether you're direct investors or practitioners building portfolios for clients, you're all going to have different objectives. You're all going to have different things that you need to do for yourself or your client, which really means that you have different ways that you're going to get there. There's not really right and wrong ways of doing this. I mean, we're fairly agnostic about, do you use funds, do you use ETFs, do you go active, do you go index? It's all about where you're trying to get to. And at the end of the day, all of these products have implications. They all have characteristics. So it's all about living with the implications of what you choose to do. For some people, very simplistic portfolios can be great. For other people, simple may be a bit constricting. They might need something a little bit more complex. That's fine too. We ultimately think you need to work out what it is that you need, what are the tools that you need to get you there, and work with that. You can get sort of very tied up in a knot, we think, about overthinking this sort of stuff. You've really just got to approach it in a fairly simple way and work out what is going to be best suited for you. So LICs, LITs, ETFs, we're all dying of acronyms up here. But at the end of the day, we get a lot of clients say, well, which is best? And we don't really think that that's the best way to look at it because, again, as we're saying, there's all different objectives and there's different asset classes and there's different strategies and everybody's, going where they need to go, but not everybody's on the same road. So we think that, people need to identify what are the pros and cons of all these vehicles, and they all have pros and cons. I think one of the interesting ways of looking at it, if you look at this table, here's some of the sort of high-level characteristics of some strategies that we see and where they sort of sit, whether you're a LIC or a LIT and an ETF. So obviously for retirees, income generation, smoothing of dividends and franking credits, LICs being made up in a company structure, are pretty good at doing that. It's not to say that you can't do it in a trust structure like a LIT or an ETF, it's just that it's a little bit more difficult. There's always going to be exceptions to the rule with these sort of things, but that's probably one of the ways to look at it. Dealing with illiquid assets, so a closed-end fund like a LIT or a LIC can be quite useful as well, and illiquid assets is something that's definitely getting talked about more now. It is a little bit harder in an ETF, again, not undoable, it's just got to be approached with care. Trading away from NAV. So, in LICs and LITs, this has been the big one that a lot of people kind of get nervous about. And we would say it's neither here nor there. Some people like to beat their chest and say, oh, they're flawed and all this sort of thing. We don't think it's that simple. It's about understanding what the limitations are with some of these structures or what are the characteristics of some of these structures and making it work for you rather than against you. So with that in mind, what I've got here is just a chart showing premiums and discounts over time for a LIC and an ETF. These are both big, well-established vehicles in Aussie shares. So the orange bars is obviously a LIC. You've got that characteristic trading away from NAV, whereas the ETF, structurally is designed to trade in a very tight band around its NAV. That's fine. This is just the characteristics that you live with. But thinking about that from a portfolio construction perspective, what you then get to is, let's look at the returns over time. So what we have here is another pretty well-established LIC that's been in the market for a long time. The green line is the portfolio return. So the portfolio return in that company net of fees. This is what they generated for you. The red line is the shareholder return. So this is your dividends and the share price movement over time. Obviously, when you're thinking about the premiums and discounts, this is what you get. You get that amplified trading around, overshooting, undershooting, overshooting, undershooting. That's fine. You've just got to understand that this is what it does. Any listed vehicle is probably going to add anything from 20 to 40% extra standard deviation to the underlying portfolio. Again, it's not good or bad. I mean, if you're a trader, some of these opportunities can get thrown up are great. But what it's about is, for yourself or for your clients, is getting them not to lose it when they're trading at a 40% discount. And also thinking about the implications of things in a portfolio around rebalancing, building your portfolio. Obviously, if you're in a fund or an ETF, where you don't get that extra amplitude around what the portfolio is doing, these are just the things that you have to think about. In an ETF, conversely, we're not going to go through all the things in ETFs because, hopefully you all know that. One of the things that we think is a little bit underappreciated is the round trip cost. You have to look beyond fees. Doesn't really matter whether you're looking at index, smart beta, active, but particularly the buy-sell spreads on these things. So what this chart is showing is, the buy-sell spread versus the fees. We won't worry about the fees too much. Everybody knows that index strategies are comparatively cheap, active strategies are comparatively more expensive, but look at the buy-sell spreads. So when you think about this in terms of a managed fund, where those are essentially fixed, here they're a bit more fluid, and sometimes they can be quite high. So yes, you can get around some of it with limit orders, but it's thinking about that round trip cost, thinking about the best execution, thinking about, is this the best translation of how to access a strategy? Sometimes it's because the vehicles are a bit small, and as these vehicles grow scale, that will change over time. But it's just about thinking about the implications. The asset allocation, this is a bit similar to what Chris threw up, but what we would say is that you've got to look at your tool set that's available. So this is all the major sort of asset classes and sub-asset classes that we look at. In ETFs, if you were looking at just doing a portfolio on ETFs, everything that's here in the green, you could get right here, right now. In LICs and LITs, a little bit different in some areas, but this is what's available. So I think it's worth remembering, depending on what you like to have in portfolios, you've got to look at, okay, is it actually available in the structure that I want? And what are the implications of holding that in that structure? We would say for things like LITs and LITs where you can trade away from NAV, looking at some of the strategies which might be a low vol or a low beta or something that's sort of a little bit different from long only. Think about, does that have implications for the translation of that strategy? If you've got a market neutral fund that can trade well away from NAV, is that the best expression of it? If you hold it for a long term, probably doesn't matter, but don't get confused by the short-term movements. When we get into the portfolios then, look, on the left, this is a very simple example of a high growth portfolio. You could do that all in ETFs if you wanted. If you wanted something a little bit more granular, look at these red elements on the chart on the right. Some of these are going to be available in listed formats, some are not, but again, look at the expression of what's there. You're probably getting fewer options available, yet more products will come to market over time, but not everything is perhaps going to be the best expression of what you want. So these are fairly generic style portfolios. The one on the left is not sort of one that we would necessarily run exactly. The ones that Zenith runs are more like the ones on the right. We have a lot of stuff with liquid alternatives and some of the finer elements in international equities, like listed infrastructure, etc., and the Australian and global long short. Can you get these in an ETF or a LIC or a LIT that is the best example of that strategy? Sometimes you can, but you've just got to look at what suits you. So look, that is really about it. Again, as we said at the start, we're not trying to build portfolios for you. What we really think is worth considering is whether or not the vehicles that are there are going to suit you. And this is particularly relevant, and Chris made this point earlier, saying that in ETFs particularly, about $9 in every 10 are essentially either index or smart beta. So if you're really looking for active strategies, there's not a lot of depth of field there yet. It'll come, but right now, you may not necessarily get what you want if active is what you want. I mean, if index is what you want, there's plenty there. So, this is a fast evolving market. More and more of these tools are going to come over time. So it's all about looking at where you're going, what are the tools that you need to get there.